Hello and welcome to a lesson on advanced central bank data theory and introducing session context. I do not think I have done a video on session context proper, and I believe this should be an introduction into the concept, which you can use for, it is specifically utilized for day trading or intra-session trading. All right, so before we go into advanced central bank data theory, the first thing I wanted to discuss before we go into looking at price action, and I'm going to use today's price action to discuss the concept. But what we're going to talk about today is price delivery. Okay, and this is kind of like an advanced video for students. But I fully understand if you've gone through the course on central bank data range, or if you understand what central bank data range is, then you should have no problem grasping the concept with advanced central bank decision theory. So we call it CBDR for short. So I don't have to keep saying central bank decision theory or central bank data range every time on the lesson. Now, the first thing you need to understand in terms of price delivery is that the markets are coded to deliver algorithmically. Now, I believe I've done a video before on how the market starts a delivery cycle where the market starts expansion, and a lot of times you would see when the market starts expansion, it does it very inefficiently. And there's a fundamental and underlying reason as to why the market delivers like this. And it's not because of buying or selling pressure. Usually it is due to artificial pricing through algorithmic channels. Now, when it comes to price delivery itself, the understanding to session context and the understanding to the central bank decision theory is that the algorithm which delivers price, even though a lot of people like to convince you that the markets are not connected, the markets are independent asset classes, that is absolutely false. The market in reality is actually connected across multiple asset classes. Delivery of liquidity is coded through time. And when we talk about delivery of liquidity coded through time, I'm more specifically talking about the time of the day relative to the different high economic impact releases or major economic impact releases, and also the time of the week. They have a very strong influence in terms of price delivery or displacement, both intra-week and also intraday. And this understanding of price is what we are going to use to develop our understanding of the central bank data range and also understanding session context. So before I go into an explanation of using central bank data range and getting accurate levels, you have to understand that the reason why these things work. And when I do lessons like this, I don't just like to show you how to do them and you just go and carry on doing them without understanding fundamentally why you're doing those things. Okay, the goal is to give you a fundamental insight into why something should happen in price. Why is the market delivering the way it is delivering? Why is the market doing certain things? That's always been my goal for years now. And honestly, I believe that's why I have a very deep understanding of price action itself. Because the goal is to understand why the market does certain things and to understand how to take advantage of them or how to avoid certain conditions in price. Now we're going to talk about advanced central bank decision theory, and we're also going to talk about introducing session context. So I'm going to get rid of all of this, and what we're going to do is we're going to look at USD/JPY not USD/JPY, Eurodollar from today. And I wanted to use the chart of Eurodollar to explain central bank decision theory. And then we'll go into session context. All right, so going into price, if you follow through with our analysis from yesterday, we're looking for weakness off of this bearish order block. And if you take the low of that bearish order block, you essentially have a daily premium in price. We still have all of this inefficiency at the bottom that the market could seek. This is all the fair value gap down here, which the market could seek. So we saw the market actually trade out into that discount and saw a little bit of a displacement higher. Now, if you go and look at the economic calendar for the week, you can see on Monday there is just one major impact release, and then Tuesday all the way up into Friday, it's just a lot of, or it's heavy releases due. Now, whenever I see a day that there is very little release for, let's say, New York session, or there is no release at all, usually that is potentially a low probability day. So that's a day where you can see the market either retrace against order flow, because usually that's what the market would do. Classically, the market will retrace against order flow to build in more liquidity in direction of order flow, or the market will go into a squeeze, and a squeeze essentially is a small range day. Now, the understanding of squeezes and prices, small ranges begets large ranges. It's just basic understanding of price delivery, right? Consolidation begets expansion, expansion begets consolidation, and that's how it goes also when we talk about the weekly ranges. Now, when it comes to the price action for today, you can see obviously that Tuesday just high impact release around right around London Open. On Wednesday, we also have AI impact release in dollar around New York. Thursday, same thing. Friday, same thing. Friday actually is NFP. And you can see on Monday, we only have two major impact releases on Euro. Okay, and that is during London session. So, not London. Monday is a very strong candidate for a low probability day. So now, how do you engage conditions like this? I did I did two videos on what setup I'll trade for life. I also only trade one setup, and on the second video, I think I talked about ideal conditions for trading and not ideal conditions for trading, or low probability market conditions. When you get into days like this, because sometimes on Tuesday you could see a Tuesday where there's potentially no economic releases, what you always want to do on your journal is you want to outline that as a low probability day. Now, you can still go in and trade those kind of days, but again, that means you're not just going to approach price with your regular expectation. You're going to have to wait for manipulation, because a lot of times the market would go into a squeeze, and if the market goes into a squeeze, it's going to run liquidity on both sides of the range. If it's going to run liquidity on both sides of the range, you can get absolutely frustrated and bid up by the market trying to catch a setup. And it is frustrating because I've done this for years before I grew from that and just stopped trading ranges like that altogether. So we already outlined Monday as potential. Now, we're not saying for sure it is a low probability day. We're only saying potentially it is a low probability day, just based off of the economic calendar. And now remember, the economic calendar is a roadmap into price delivery, because price delivery is coded through time. That's the first thing you need to understand. So whenever I see a day like this, for example, where there's high impact releases, I know there's bound to be some measure of volatility for that day, right? And you can see Wednesday, Thursday, Friday. But when I see a day like Monday, where it is little to no high impact release for that day, especially not during the New York session, that is potentially a day where we could not see a ton of delivery price. Now, that is number one. Okay, number one is understanding that price delivery is coded through time, and time is influenced by time of day, time of the week, and your economic calendar. Now, by understanding these three things, you can identify ideal conditions or potentially not ideal conditions. So the way I would approach the markets if I was trading would be, already have defined the expectations. Now, the reason for defining daily profile as high probability, low probability, medium probability is, by setting expectations. For example, I'm not going to go in today and pyramid trade. So if you know what pyramiding is, it's essentially identifying a target objective on the lower time frame and taking multiple entries. Every time I take an entry and the market displaces in my direction, I'll add in more, and I'll add in more and more and more and more until the market gets to the target objective. And then by the time I'm out, my what was supposed to be like a 1% risk on the initial entry is now around like a 5 or like a 3 or 4% risk, because I've scaled in multiple entries. I've built in a pyramid, so that's what pyramid is called. I am very selective about the time I'll pyramid trades. Pyramid trades is one of my best ways to quickly ramp up capital and gains in price. Okay, but during days which I've outlined as not ideal conditions or potentially low probability conditions, my best bet is not to go into the marketplace just seeking for trades. I have to wait for manipulation. I'm looking for a sudden run against my intended direction with a low risk liquidity draw, and that sets the stage for my expectations for a trade, if that makes sense. So we've outlined, or I've described, how you can identify potentially low probability market conditions just through understanding timing, okay? And they will give you clues as to how the market should deliver. Now that's part one of this presentation. Now let's go into part two of the presentation, and we're going to talk about session context, and I'm also going to talk about the central bank dealers range. Now, it's not just enough to understand what days are potentially going to be low probability days. It's also very important to understand that the market proves that to you. Now, one thing I keep seeing is all the concepts you're being taught, they always will submit to price, and that's why you never arm wrestle price. Okay, price will give you feedback if your concepts are working or not. If you're looking for bullishness in price, price has to confirm your expectations of bullishness. How does price confirm expectations of bullishness? It has to trade through premium arrays, and every time it trades down to a discount array, it respects a discount. And usually, if I see situations like that, that's when I'll go in and pyramid trade. Once I identify a level of liquidity and the market wants to meet my expectation exactly how I want, then that's an avenue whereby I'll go in and add multiple entries, and I'll scale in to a winning position. Okay, but now in a situation like this, and we're talking about euro dollar, so what we've done is we've outlined our key premium and our key discount. And our key premium for euro is this bearish block here, and our key discount is this discount right here, which is a fair value gap. Now, if we go on the lower time frame, and I wanted to talk about advanced central bank dealers range theory. Now, what you can see here is we're going to identify the central bank dealers range from Friday changeover going into start of Monday. And if you go back on Friday, let's start with central bank dealers range, and this is the end of the central bank dealers range right here. Okay, now if you take your Fibonacci and you are trying to identify your standard deviations with the central bank dealers range, and you take your, okay, if you take your Fibonacci from the high, I think let's choose FXCM. Actually, I'm gonna get rid of all this. I prefer the price fit on FXCM. All right, so if you take your high between the time window, and our time window for the central bank dealers range is here, starts around this time here, which is 2 p.m. Eastern Standard Time. I already covered this on the day trading course. So 2 p.m. starts your central bank dealers range, and it ends at, let's go to the left. Yep. And at 8 p.m. So around 2 to 8 p.m. is your central bank dealers range. Now, what we have here is obviously we have, let me get rid of all the levels here. We have a high here, our central bank dealers range, and the end of our central bank dealers range. Now, what I've taught you with using this concept is you are looking to outline the highest high and the lowest low within the range to identify your standard deviation level. So this is one standard deviation above your CBDR, and this is one standard deviation below your CBDR here. Okay, so you have one standard deviation above your central bank dealers range, you have one standard deviation below your central bank dealers range. Now what you can see here is that the market never really gets up into our one standard deviation with our central bank dealers range. Now this is where we go into the advanced theory with your central bank dealers range. Now remember, the central bank dealers range in and of itself means absolutely nothing. It is absolutely nothing without an understanding of, number one, your PDRs, and then number two, the drawn liquidity. If you don't understand the drawn liquidity, these concepts are useless. And this is where a lot of people feel, especially online. So when I go out there and I look at Twitter or Instagram and I see people using central bank data range, they're using it all wrong, because the first thing you're doing is you're going up to pull up a central bank data range without an understanding of how price is supposed to deliver. And I'm teaching you that this, again, what comes first is price, not the concepts. It is price. If price is not verifying to you your expectations are wrong. Okay, I want to repeat that one more time. If you have expectations of price in terms of if it's low probability, high probability, medium probability, and everything, okay, and how the market should deliver, if the markets are not delivering with your expectations, you are wrong, okay, and your narrative would fail. So all of this is all painting a narrative for how the algo will code delivery. You can remember delivery is highly time sensitive. Now what we're doing here is, if I zoom in closer into the central bank data range, I want to draw your attention into this. Now the highest eye within the central bank data range is the eye from 2:50 p.m., which is this eye here, and the lowest low is the low right before the opening price. Okay, this low right before the opening price, for the start of the new day, that's the lowest low there. Okay, so our new day opening gap starts from here. That's our new day opening gap. So we have our new day opening gap there. Now this is a different topic entirely. I've talked about new day opening gap, but this is not our interest for this session. What just happened? Let's go back into this. Now, when I'm looking at this kind of range in terms of delivery, this candle here is a gap. Okay. This candle here, if you look at delivery of price, it's volume. You have volume until right before the crossover into the new trading session. Then you have the market gap down and it gaps up and starts to deliver lower. So we have a gap lower and then a gap higher here in price. Now, how is it a gap lower, Gene? Look at the delivery in price. This candle trades lower, and then the next candle does not start from the closing price. Instead, it starts from up here. So I'm viewing these two candles as a void in volume. Okay, so when I mean a volume, just like you have a volume balance where there's an imbalance in volume. If you took these two ranges, that's a new day opening gap. Okay, so when I view these two candles like this, that to me is not real delivering price. So again, the protocol with our central bank data range is we want to measure from the highest body closure to the lowest body closure, reflecting true volume in liquidity. So where's the true volume liquidity? Where's the lowest down close candle? It's this one here. It's not this one, because that's a gap. Our lowest down close candle is this one here, not this one, because it's lower than this one, and this is lower than all of these ones. So what I'm going to do here is, now let's use the highest closure in that range and the lowest closure in the range. Okay, we're going for the lowest closure in price, not this one, because again, that's a gap. And this is where we come about the advanced central bank delivery theory in price. Now, if you go and you look at the range, if you measure one standard deviation above our central bank delivery range, that gives us the high of the day. And if you measure 1.5 standard deviation below our central bank delivery range, that gives us the low of the day here. Okay, so we have the market go 1 standard deviation higher and 1.5 standard deviation lower in price. Now, this is the advanced theory, and the reason for this is that the market, again, the algo is coded to identify a certain time window. I'm going to teach you even more now to utilize central bank delivery. This is just the first part of an advanced lesson with central bank delivery. There are times whereby you're going to have to use the central bank delivery from the previous day to actually identify or mark up the high and lows potentially for the next day, right? But that's a different lesson entirely. But on this one, the reason why we're not using this candle here is because this candle does not reflect true volume in price. Okay, there's no true volume in terms of there is no true volume in terms of price delivery. So the algo will reference the candle that had the lowest volume, which is this one here. And we're using the closures because, again, the bodice reflects the most amount of volume price, and that's where you get your run higher. Now, why would this be something that your attention will turn into in terms of looking for an execution profile or a possible tradable move? That's because that 1 standard deviation aligns with your higher time frame premium. Again, the sentiment was looking for lower prices in Europe. If you watched the forecast yesterday, this is what we talked about. And if you go on your lower time frame, and let's identify the low of that daily candle. So the low of this daily candle is 1.10378. So 1.10378 and 1.10378. That's the low of the candle there. And if you go on the lower time frame, you're gonna see that's your high time frame level there. Now, why would you expect this kind of delivery? And this is where we go into the presentation on session context. Okay, this is something, I think I'm the first person to actually talk about the session context in detail. Maybe eventually you're gonna start seeing people talk about this, but again, let's go in here. And what I'm doing here is I am delineating London session, New York session, and then London close. So we have London, New York, and London close here. So I'm gonna make them more pronounced so you guys can see them. You can differentiate the different sessions. All right, so we're making them more pronounced, and you have your London session, London launch, New York session, and then London close. Now, again, if you go back into how I taught you how to anticipate low probability market conditions using your economic calendar, aka day of the week, what you can see here is that if we are expecting today not to be a day where we see strong displacement because of the lack of high impact releases, because if you look at the days ahead of today, there are very key economic releases coming out. So we expect there to be a lot of volatility in price. So it makes sense for us to anticipate a small range day today. And today's a small range day because look at how many pips we did today. We did the entire range for today was 51 pips. Now compare that to Friday's range. And you can see Friday's range was double the range for today. And you know, if you compare that to Thursday's range would be almost triple. Thursday's range was actually more than triple the range for today. So again, this is a small range day because of what I've told you in terms of anticipating market delivery. Now, it's not just enough to identify a possible, because what you're doing with what I just taught you is you're identifying a possible low probability day. It's just a possible low probability day. Now, what you need to see is that the market needs to confirm that to you. And this is where we go into session context, okay? Now, with session context, if you see a failure in the previous session to deliver a strong order flow, okay, that usually would be a very strong indication that could continue into the current session. And you're going to see very strong manipulation in the current session. This is actually my journal, okay? And what I wrote down in my journal is from 2021. This exact delivering price, but I'm teaching right now, and that's why this stood out to me. It was written down in my journal as part of a low probability condition to avoid trading in New York. And one of the conditions was if London session in an anticipated low probability day, if London session does not see significant delivery, aka it stays range bound, then more likely than not, New York is going to be a heavy manipulation because a lot of traders are going to try to catch the breakout either side of the range, and the market will manipulate traders going into long close, and then the true delivery will start after traders have been flushed out of their positions. Okay, so now I was opening my notes actually just to see the part of my book where I wrote this down. But now what you can see here is during London session, did we have a very strong delivery? Of course not. Why? Well, let me get rid of all of this first. First off, if we look at the delivery from Asia, that's this high here and this low here. Did we get out of this range, this initial range from Asia going into start of London session? Were we able to leave that range with serious conviction? No. Look at where we closed for London session, just a little bit above the range. And then we'll start New York session by trading down into the range. Now look at what the market does here. The market runs lower, acts like it's about to go and sell off. No, it runs high and puts the break on anyone that was trying to short. Okay, now we're about to go long because this is a breaker block and we should look to go long on Euro. No, anyone that's trying to go long, the market puts the brakes on them. All right, this is a breaker block. We're trying to go and sell short the breaker block. Trying to look for the sell liquidity down here. No, the market goes deeper and runs liquidity on the buy side. Now, how would you know that London close would have offered the delivery? Because of the session context. If your anticipated delivery profile is looking for weakness in price, okay, did London offer the weakness? No. Did New York offer the weakness? No. If both London and New York were manipulation against order flow, what does that mean? It means both sessions were being utilized to engineer liquidity. Now let me explain market delivery profile. The market will only seek to do two key things. It will seek to engineer and reprice liquidity, or it will seek to rebalance inefficiencies. Okay, those are the only two things the market does. It'll either go and engineer and then run for liquidity, or it will seek to rebalance inefficient delivery or order flow. So in each session, you have an anticipated buys. And the buys always have to be in alignment with your high time frame premise. What's your high time frame premise? Is it bullish or bearish? I already told you this morning that your bias is looking for weakness today. So you are anticipating weakness in price. Cool. Now, if you're anticipating weakness in price, is this a good point to go on short during London session? No. Why is that not a good point to go on short during London session? It's just no runs on liquidity. There's nothing indicating that we should go and be a seller during London session. Also, there's no strong displacement on the downside to convince us that the algo wants to seek sell liquidity. So no, there is no reason as to why we should go and sell short during London session. Now, do we go in and sell short during New York session? No. Why? Because our anticipation is this is a day where it's just not going to be strong displacement in price. Because if you look at the economic calendar for the week, the heavy hitters are for Tuesday, Thursday, and Friday. Now, I'm not saying Wednesday, obviously, we have a strong economic release, which is non-foreign employment chain numbers on dollar. Okay, we can see very strong delivery on Wednesday, but it has to depend on market delivery for Tuesday. Again, the market delivery is not independent of one another. The market delivery for a specific session will be heavily dependent on the delivery profile for the previous session. So what I do in each session is, if I have a sentiment in price and the sentiment is wanting to see a specific level being met, and in this case the specific level would be the sell side liquidity from New York session the previous day. Okay, now remember on the course I talked about easy targets as you drive liquidity, which is previous day's low, previous day's high, previous session's low, previous session's high, and stuff like that. And that also applies here. So if I have an anticipated bias, which is I want to see the market sell short, right? Now, what I'm going into when I'm looking at each session is this session set to price into my liquidity pool, or is it going to induce liquidity against my liquidity pool? So what that means is if I'm anticipating a run on sell side liquidity, then going into each session, I'm looking at the delivery profile. Now, if London session was a manipulation, a very strong manipulation play, okay, then I would expect New York session to start the displacement lower. But London session was not a manipulation play. London session was just simply a consolidation profile. Now, you can come and make the case that London session was obviously trending. Now, let's do this. Okay, let's choose a replay tool here. Now, look at this for London session. Does this look like a market that's strongly trending? Is this a market strongly trending? No. We have a high, low, it's consolidating inside the market. It's not doing anything, it's consolidating. What do you want to see for a manipulation play? You're looking for strong displacement price. That's what you're looking for. And then going into New York session, do you want to go and short this here? You're shorting a triple top. Don't you think retail is looking at this as 1, 2, 3? That's resistance. You're shorting that. Don't you think so? That's what everyone else is thinking. So what do you anticipate for New York? Heavy manipulation. So meaning you don't go in and take a trade because you're anticipating heavy manipulation due to the day of the week in relation to the other days where there are strong deliveries in price, and also the context of the previous session, which was a lack of displacement for either manipulation or engineering order flow. So if London session was neither used engineering manipulation or order flow, it was simply a consolidation profile. So that means New York potentially can be utilized to engineer order flow by manipulating price. We have our standard deviation up here. We have traders chasing the longs here. We have traders shorting a triple top here. It does not make sense for us to go in and try to look for a trade. Again, you can see what the market does. And the reason why the market goes like this is because the market is running both sides. So it goes up here, and then the one who jammed your stops because they saw this displacement lower, they're stopped out. And the one who's buying this as a discount, there's just like you saw on Twitter, no one's buying this as a discount, they're stopped out. Then the market runs higher again, and then those was selling short the triple top, they were jamming your stops because they saw the market run lower, they're stopped out of the marketplace. As soon as the market goes into London close, what does he do? It starts the delivery cycle. Why does it start delivery cycle? Because the previous cycle was used to engineer liquidity. How many times have you heard me talk about deferring liquidity? If we don't see the market offer the liquidity we're anticipating today, then it could be deferred for a later time. The reason why I say that is because when I have an expectation in price and that session does not offer the expectation, and I have no reason to switch my sentiment because none of my parameters have been invalidated yet. All I simply do is I understand that session is being used to engineer order flow, and I will just say, okay, liquidity is being deferred, which is the liquidity I'm targeting. It's being deferred, and all I'm going to do is just wait. Okay, I'm not going to force entries. I'm going to force trades. So now let's say you were not privy to this information before, and you went in and traded during the New York session. If you start to see the market chop both sides like this, what do? I've taught you this before. If you take a loss, wait until the next session. And as long as your expectations are not invalidated, then the next session should offer the liquidity. Because what a lot of traders will do is they'll go in and they'll get frustrated trying to trade this kind of condition, and the market will chop them both sides. The market will chop them higher, chop them lower, chop them higher. And when they are absolutely frustrated, that's when the market actually starts to displace. All right, so this was the presentation on advanced instrumental string theory and session context. Hopefully you did enjoy this lesson, and I will talk to you via the evening commentary tonight. Trade safe.